All right, good morning, everybody. Starting just a few minutes early so that we can talk about the website real quick. If you are new to trading, these courses are a really good way to get started. There's so many things out there that we can learn, so many different ways that we can trade and different paths that we can take that it often feels like, well, the analogy that I generally use is it kind of feels like you're sitting out in the middle of the ocean. You can't find solid footing. Everywhere you look, everything seems like it's a long ways off and there's just nothing to grab a hold of. You're almost drowning in the amount of content and information out there in the world. And it just makes trading difficult, or learning how to trade difficult, because all the different paths. But when you come over to the bullish bears, we have such diverse traders that you can find a style that suits what you're trying to accomplish, what your goals are for the account that you're using. But you still have to have a good starting place. Now, the nice thing about trading with price action, the way that most of us trade, the moderators at the bullish bears, once you have a price action strategy or a concept, it really goes anywhere that you want to go. Forex, crypto, stock options, futures options. So if you begin working through the course's material, picking up that skill set of strong money management and reading price, those two skills really do transcend all the different trading styles out there. It's a really great place to start. So no matter what kind of trader you are, going through the courses is a really good idea. Uh, when I was new, I didn't go through any kind of beginner stuff. I thought, well, I'm already trading. I don't need the beginners. I understand. I know what the candle is. I can see red and green. It makes perfect sense. I don't need that beginner stuff. That was a mistake. If all of us start at the beginning, we would be so much better off. I see questions all the time from people that I've seen their name in the chat, for a month or two. So I know that they're not new to the bullish bears or new to the community, and they're asking questions that are obvious. They didn't go through any of the beginner material. And if they had, they would not be so frustrated or lost. So just a short little plug before we got started. Check out the courses. And if the courses are something that is nothing more than a review for you, then hit the Next Level library, because I really made a lot of in-depth content. And one of the biggest complaints that I get from the Next Level library content is it's too advanced and that people don't understand what it is that I'm talking about. If you go through the courses, that will help bridge that gap. All right, done with the shameless plug. So we've been using FX Street, kind of a good place to start when we're looking at the economic events for the day. One of the reasons that we've been using FX Street is that it's free. Gotta like free. And they usually have a little excerpt up at the top that focuses on the dollar. And if you've heard my streams before, you'll know we focus on the dollar, but we don't always understand the why of the move, right? A strong dollar or a weak dollar, you still have to think about, why is the dollar moving? There are times when it's a reflection of the global risk, and then there are times where it is a reflection of global exuberance. Before we went Before I shut down and left my office last night, we were risk on in Asia, right? That just means that we're bullish in Asia overnight. We got up this morning, not so much, right? The Asian markets closed, London's open, market kind of took a turn in the other direction. So we can see the economic events on the schedule for today. They're all a lighter color. If they were anticipated to be impactful, it would be a darker color, solid bar, and that's not what we have. So all of these that are on the list, mildly anticipated to be impactful, right? Just a mild anticipation. So we go to Think or Swim, hit the market watch, bring up the calendar. if your calendar looks like this, really cluttered and it's got a lot of things on it, the fastest way to get it cleaned up is just hit the show all button, turn everything off, and then just turn on the Econo Day event. I like to grab that description and bring it over so that the description is right next to the time frame. And now we can see 8:15, 8:30, 10, 11, and 11:30. Now, the dollar opens at 8, the bonds open at 8:20. It's no real big deal to already be standing on the sidelines at 8:15 and 8:30 when these two are coming out today. The 10 a.m. on Mondays, and I get it, this is Tuesday, but it's our first trading day, all right, for the markets. We've got to absorb all of that news from the weekend. There is this economic theory that the markets have priced in everything that's going on, right? That news is in it, and that works until the weekends come. And then on Monday, or in this case on Tuesday, the market has to, we got to get a little bit of price discovery, and it has to price in all of that news from the weekend. Generally, it takes, anywhere from 60 to 90 minutes, which would put us around that 10 a.m. time frame anyways. So just, maybe tiptoe, approach with caution during that first 30-minute window. As a general rule of thumb, I'm not normally trading between 8 and 10 in the morning anyways. But, there you go. We do have additional auctions today at 11 and 11:30. These are impactful more often than not. There's been days where they're on the books and 11:30 comes and nothing happens. It's fine. But generally, if we've been trending all morning, lunch is where we pause, and then we look at the 1 to 3 different ways that we can move going into the afternoon. If we've been range bound and we have an additional auction at lunch, this very often galvanizes us out of that range and into a trend. So just have your eye on the clock. 11 and 11:30 is the events on the day. All right, looking at the ES, I am out a little ways. We're on the 1 hour. I thought that was a really good way to take a look at the current conditions. 4,600 is kind of an impactful zone, but it's only the midpoint from this bigger range that we've been in that takes us all the way back to October and November. That was the low. And we've just basically been ping ponging back and forth, high to low, high to low. We had a fake out, breakout, and then back inside the box again. So we're in the middle of the range. As you can see, we've been making some significant moves in the last few days. When volatility is coming in the way that it is, these moves are just going to continue to get more and more violent. Remember that volatility is a nerd way of saying expected movement. So when things have a high implied volatility, there is an expectation that the market could make big moves. That's just, you get rid of all the nerd speak and put it into plain English. Another way to look at volatility is that the candles are getting bigger, right? So without any tool or indicator of any kind, you just look at the size of the candles. Especially if you go out to a daily chart, which is a really good way to start this conversation for the week. It doesn't matter what kind of trader you are, short duration, long duration, day trader, doesn't matter. You definitely want to look at a daily chart. Just take a peek, take a look around, ask, are we going to hit anything today? The size of the expected move for the week, it helps if you put it into perspective of what last week's size was. So that was the expected move range from last week. It was a 5-day week. Now we're in a 4-day week. And this is the size of the expected move, that red and green line here and here. So we're very close to the low of the expected move already. That's a week's worth of movement made in less than 12 hours, right? If you count the fact that the futures were open Sunday night and part of Monday, then the market has had more than a day to make a move. Still, that was the range anticipated for the week, not for a day and a half. If you go back and look at how often the market closes inside of that range, it is more than 80% for the S&P. But you will also find that when it starts to break the range and close for the end of the week outside of the range, that it generally happens sequentially. It'll happen once, and then again and again and again and again until something really violent happens and breaks the cycle, right? But that when it's staying in the range and it's just this constant nonstop in the box again and again and again and again and again, right? So when things do start to get really violent, like this window that we're looking at up here, the candles begin to get really big, right? Notice when things were trending and everybody was happy, it was one time framing, consistent, persistent price direction. The candles weren't so big. It wasn't very violent. Volatility picks up. The candles get really big. The size of the expected move gets bigger. We're in the situation that we're in now. So for today, after price discovery and with the economics on the table, the additional auctions are frequent. We see them all the time. It's mainly going to be the 10 a.m. numbers that is going to make or break the rest of the trading day. So we want to see those come out, and we are down 1%. We have an ADR of 1.35. So the ADR, the average daily range, is counting back the last 20 days. In the last 20 days, what's been the average movement on the ES on a day-to-day basis? Around 1.3%. Well, we've made 1%. In a normal average day, we could still make another 0.3. If today is above average, we could easily make another 1.3. There's no market maker move forecast on here at this point in time, but it wouldn't surprise me if we do end up picking up a market maker move. So a move to the upside, we're going to have to breach through this trash from back here. We are back above the pivot point. That would be the lowest point of that trading day. So we're back above that. That puts us on an inside day if we discount Monday. And there's some technicians that won't deal with the holiday. They'll just like ignore that data. I don't quite know how to feel about it. I really think that you could do both, analyze it and then turn off that data, or ignore it and then analyze it again. I don't think we quote always want to do one particular thing. So, maybe do both. Find a happy medium that you're comfortable with. I've never been a big fan of ignoring data. It just doesn't make much sense to me. If I have it, I want to use it. So we do have data from Monday. There's no good answer to this. I'm going to really focus on Friday's trading instead and kind of just take Monday as a part of today. In which case, we're back inside the box. From yesterday's highest point, or from Friday's highest point to its lowest point, would put us our range for the day, right? So it would be 4606 to 4666. It's easy enough to remember. Should we break below our own Globex low, we're going to focus on this institutional pivot point from last Monday. And that is also very close to the weekly expected move. There is a cog line at 4611. So just kind of keep that cog line in mind. Remember, COG, center of gravity, cog line. It only exists on the ES. At this level of the market, basically on the 11s. So 46.11, 47.11. If we remain inside this box, I really don't think that we're going to have much of a trading day. It's very likely to be choppy and nasty and uh, tradable. Yes, for newer traders, maybe a little too violent. For small accounts, probably want to stand aside and not attempt to trade it. Uh, that's because in your smaller account, you probably can't get far enough away from the market. You wouldn't be willing to use a stop size that you need to be far enough away from the market to avoid getting stopped out all the time. Right. And so even before your trade has a chance to prove that you're right or wrong, and you just get stopped out. We do have a volume shelf around 46.38. If we do happen to break through that cog line, that would put us back inside of the volume profile. Or the Nasdaq. Same thing. We're flirting with some critical levels. We already made it to the weekly low, the weekly expected move. Yeah, you don't find cog lines in the traditional sense, and I'm certainly not going to be able to explain them in detail in a briefing like this. Hit me up after I'm done with the Zoom in the Discord, and I will attempt to type it out. It's a little bit of detail. The person who came up with them was on the floor of the New York Stock Exchange when they were 9 years old. Third generation trader, quant nerd, genius. The guy built the Thinkorswim platform on the analysis side and in all of the options side. And it is very specific to flow and looking at orders, right? And it's like when he described it, it was 9 to 18 days of back to back searching, going back through the prints and crawling through the data to validate and verify that there is a COG line there. And again, are only on the ES. And at this level, they've really been only hitting at the 11s. Um, if it takes that guy that much work, I don't think you and I are going to be able to find it. It would even be uh, kind of a little hard to believe that I would even be able to articulate to you how you could find them. Right? I don't even hunt for them. I just write down the 11s and say there's cog at 11. It's as easy as that. You get your drawing tool out, you mark an 11. It's only on the ES. Simple enough. So for the NASDAQ, we are sitting at that critical level. You can see the range very clearly. High to low to high, high to low, high to low, high to low, low to high. Right? Back to the top, back to the bottom. Well, we're at that bottom critical level. Should we break this low, we're going to deal with last Monday, just like with the ES. And then below that, it's going to start to get really nasty. Um, there was a little bit of talk about redemptions on Bloomberg this morning. I don't think we're there yet, but just the fact that I even heard them speaking about it, I didn't catch the whole interview. So I don't know if they were just rehashing the past or if they had already started to see redemptions beginning to run, but it's something to keep in mind. Right. And if you hit the articles this morning, a lot of them were talking about dumping tech, surging bond yields, right? Wall Street Journal, one of the main articles, bond yields are hitting 2-year highs, stock futures are falling, hit the Bloomberg, surging bond yields send Nasdaq tumbling. It's the same topic of conversation across the board everywhere you look, right? They're trying to price in an aggressive rate hike, an earlier rate hike than what had already been suggested. Interesting enough, China lowered their interest rate. They didn't raise rates, they lowered them. Bank of Japan called it flat, didn't make a change last night. at the same time that they said, yeah, we expect to see rising rates. They expect inflation to really start to get out of control, but they didn't raise their rates at that point. So it was projected 3 rate hikes this year starting in March. Now there's whisper on the street that these quarter point raises 3 or 4 times this year is not getting aggressive enough. It's not getting ahead of the problem. And that's what they're really trying to push the Fed to do, is get ahead of the problem, not chase it with these quarter point basis jumps. So now there's talk, and it began last week, of half point liftoff in March, right? So instead of 0.25, it'd be 5 or 0.5, and that's just for March. And then now they're talking about 3 or 4 rate hikes this year of 0.5%, not 1/4%. And that's what you're seeing getting hit into the market. So keep in mind when you're looking at these charts, this isn't fear. People aren't scared of Omicron. It's not shutting down the market. It's not shutting down the economy. Businesses are continuing to prove that even with supply chain shortages, they can still make money. The market's going down because there's a capital rotation going on. They're getting out of tech and getting into finance. Banks are anticipated to have uh, an impactful earnings this quarter. Well, there's no financials in the Nasdaq 100, so they're dumping tech, rotating over into financials, and then they're getting back into the bond again, trying to get ahead of that liftoff, right? Because they really got out of bonds quite a bit when there just wasn't any money in there. Interest rates were at historic lows. When they're done with their capital rotation, the things that we've been trading will be back in play, and the things that are currently starting to lift off will fade away again, right? Value versus growth, same argument all over. So Nasdaq today looking for a break to the downside below our own Globex low would have us challenging 15,160. Below that, it's going to start to get pretty nasty, right? We'd have to go all the way out to the daily chart to find this area in October as the next area of impact, right? Even this low that I have marked here ties us into the top of this price shelf back here, 15,150. If we break below 15 flat today, or even just this week, we're going to start to see some seriously crazy market, right? Some serious market conditions. Should we begin to move back up with this failed flag play, the reciprocation target is back to the highs. Right, so that's going to be the target. The failed flag play makes the assumption that a flag, which is a continuation play, is not going to continue. And it could be a bear flag, a bear pennant. It really doesn't matter, right? It's the idea that it's not going to continue. It's going to reciprocate. It's going to turn around and come back to where it came from. This setup generally starts to really stand out the longer we go sideways. Now you can see from that blue area, just because we go sideways for a while does not mean it's going to fail. It's just it's more likely going to fail, because a market that's trending should continue the trend. Makes sense. When it pauses like this, the longer it goes sideways, the more likely it is that that trend is not going to continue, or that the move is not going to continue. So we call it the failed flag, failed pennant. That's the setup that we have right now. If we're looking for a Busby on this thing, then it would be an expectation that we break the range, perhaps bounce off of the bottom of the previous range, come back and validate the old resistance as the new support, and then begin to make our way back up. Remember, a Busby only offers you back to the top. So if you're calculating your risk to reward, it's from these lows back to these highs. If you can get a runner and set it through, great, but it doesn't owe you that trend. So that covers us to both directions. Nasdaq up and down, ES up and down. Looking at the bigger picture, bring in the VIX, bring in the dollar, look at the bonds. There's been talk about the dollar with that nice little push that we had in the overnight hours, but it kind of stalled out and didn't go anywhere. We don't want to see these big sweeping moves in the bond or the dollar. Also, keep in mind it's not a teeter totter. So when one side goes up, we don't automatically assume that the other side is going to go down or vice versa. Right? When we see the dollar and the bonds making an aggressive move, we want to start looking to see how it's going to impact the S&P and the Nasdaq. Sometimes it doesn't. They make a big move and nothing comes from it at all. And then there's other times where it just really takes the market with it. Right? So watch the dollar, watch the bonds, use the VIX for your confirming signal so that when, for an example, we're breaking out of the top of a range, you should see the VIX breaking below the low of a range, right? Let the VIX be your confirming signal. If we start to see a really good, strong breakout in the futures and the VIX is not confirming it, it's very likely a fake out breakout. The sectors this morning are mostly green. IBB has is about flat. Energy's positive, but there was quite a bit of news over the weekend. Um, and I believe some of that news has a bit to do with the rally that we're seeing this morning. Both of the energy names are up more than 1%. So natural gas, energy, even USO, although it's not up 1%, even USO is up quite a bit this morning. You see, we broke through that critical level last week. Nice continuation play. So, just like it was last week, energy may be the names to look at, especially with banks having earnings. That kind of screws up a lot of our options trades that we would want to do in the short duration. We can always day trade them, right? We're talking more about, a short-term swing trade in options. If they're reporting earnings this week, the options we would want to trade, we would be staying away from. So we'd have to put more time into the trade than we may normally want. Energy and finance have been tightly correlated last year. We're kind of expecting that to continue into this year with banks moving the way they are. Energy with the news that we're seeing, this may be the play. And they're cheap enough. You can trade them as a stock trader or an options trader, or heck, do both. There's nothing wrong with tying a little bit of stock in with your options trade. Silver and gold was basically flat. If I remember what I read on FX, you can certainly jump back over there and take a look at their discussion on gold. When I was running around yesterday, the last bit of news that I heard on crypto was that there was a major crypto exchange that had shut down all flow of money coming into or out of the exchange because they noticed some, quote, suspicious activity. Now, that was 6 o'clock last night when I heard that news. I haven't gone and checked on any crypto news this morning, but that may be something to look a little deeper into. Kind of just take a look around and see if anybody's talking about that major crypto exchange. I don't want to say a name because I can't quite remember which exchange it is, but that's not something you hear very often. So the rest of the sectors are either flat or really bad. You can see the crypto ETF that we've been using, that Bitcoin ETF, BITO, down over 3%. XOK is down, one and a quarter, one and a half. We did break some critical levels on the daily, but we're holding above that 20 on the weekly. It's kind of our last defense there. We don't really have an EV market sector ETF that we can look at. So my solution was to build a watch list of EV names and kind of look at them in aggregate to see what's going on in the EV market. Not really seeing anything in here that stands out for a trade opportunity until we start to see this market stabilize and price in all the news from the weekend, right? So nothing moving in the pre-market in here unless you were running to go short. And if they're down that far already, I wouldn't want to jump in at that point, right? I don't short from the lows, I don't buy from the highs. So EV isn't looking too good. Same thing with the marijuana sector. There is a marijuana ETF, the MJ, but the marijuana industry has so many different directions that we can go. If you just lump them all into one spot, then you kind of miss the perspective. It's just like with finance, right? Finance, you've got credit cards, lending institutions, insurance, trading desks. So when you say finance, you're kind of just using a very broad brush. Same thing with energy, right? There's transportation, exploration, drilling. When you say energy, it just doesn't kind of paint the whole picture. Well, it's the same thing with the pot stocks. If you just lump them all into one ETF and call it the pot stocks, then you're not really getting into the difference between the recreational, the medicinal, the CBD side. So, an aggregate of names in that industry, and then seeing what's moving in there. Since that one ETF, MJ, just doesn't really do it. On a day like this, or on a morning like this, especially, after a holiday weekend, these are the days where I say we really have to, you know, play stock pickers, use our own scanners, not lean on the sectors to find opportunities to trade, and instead trade what shows up in our scans. I set my scans to find me things with weekly options. That's about as far as I go. I don't need to go any deeper than that when it comes to my scanners, right? I don't use a lot of criteria to eliminate things or to bring things to me to trade. This does all I need. It shows me what has weekly options. I'll do the rest myself. The one scan that I do use is a daytime scan. It doesn't even need to be, quote, a scan. It's that high low graph that is built into Thinkorswim's watch list. I've done videos on it. That is the most impactful, fundamental day trading scan I've ever seen, ever. From paid stuff, free stuff, different sites, different systems. I've never seen anything that is more powerful at bringing you trade opportunities early enough to trade them on an intraday basis. And you don't even have to do anything to it. You literally just turn it on. How awesome is that? It's the high low graph. If you're in the Discord, you can search the chat in the upper left, excuse me, the upper right corner of the screen in the large caps, and you will see where I shared a scanner and I made a video explaining how to apply it, how to use it. But you really don't have to do anything, just turn the thing on, right? It's days like this where we're going to have to lean on our own scanners because the sectors aren't going to do it for us. Also, remember that we were risk on and that this sell off in the market is directly connected to the interest rate liftoff fears, right? And it's not even really fears, it's they're pricing in a more aggressive liftoff. If any of the Fed speakers come out and repudiate that belief or in some way give them guidance that the liftoff won't be as aggressive as the market seems to think it's going to be, we could see this thing flip over very, very fast, right? And or if they hit their price in goals, because they're only rotating capital. They're not trying to dump this market. So That's one of the reasons that we keep seeing these high to low ranges, is because the market isn't scared and trying to dump everything. It's more of the idea that we're just seeing those larger institutions rotate out of something that has been working for them for years. We haven't had a taper since 2013. We've been running at really low rates. We've had an influx of help since Corona. I mean, there's a lot of things that need to be unwound, and they're just changing their strategy. Well, they got to get out of things, and then they got to get back into something else because they're not going to stay in cash. So then we see sell-offs and rallies back up, and sell-offs and rallies back up, and it's going to keep doing this until they're done. So look for short duration plays, short duration swings. Take your profits where you can. Keep your eye on the clock, and I will see you all tomorrow.